Welcome to the Bloomberg Markets Podcast. I'm Paul Sweeney, alongside my co-host, Matt Miller.
Every business day, we bring you interviews from CEOs, market pros, and Bloomberg experts, along with essential market-moving news.
Find the Bloomberg Markets Podcast on Apple Podcasts or wherever you listen to podcasts and at Bloomberg.com/podcast. All right, so let's start with you, Anurag. Microsoft, I don't know. I thought it was a good quarter. If there's dips, if I were a PM, I'd be buying the dips here. What did you take away from Microsoft? Stocks had a rip this year.
I think that's what it is. It's had a rip and people are just digesting the news. I think it was a good quarter, as you said, but people, I think, had unrealistic expectations that the AI workloads is going to blow out the cloud number, which I think will happen over the next 12 to 24 months, but it's not immediate. It's just going to take some time.
Well, in terms of things that are going to take some time, I feel like that also applies to the AI play with Alphabet, Google. What are you thinking, Mandeep, when it comes to whether that AI chatter is going to translate into actual money for Alphabet?
Well, so the good thing for Alphabet was yesterday the expectations were somewhat muted around search and YouTube. And what they showed was this business is as resilient as it can be, even in an environment where ad pricing is still facing some headwinds. But I think what Alphabet showed yesterday is, one, they are able to keep the engagement. So concerns around ChatGPT eating their lunch were overblown. And then on the cloud side, it was a pretty strong number, 28% growth, $32 billion run rate for cloud. That's pretty impressive. And now cloud business is not a drag on profitability as it was last year. So I think net, they're kind of optimizing the cost side of the equation. Ruth Porat actually was elevated into the president role. And I think once you start to see a cyclical rebound in ad spending, you will see double-digit EPS growth in this name. And they can compound for the next 4 or 5 years.
All right, so let me ask this. Either both of you guys I want to hear from. Matt Miller tells me ChatGPT, Bing is like awesome, and that Google doesn't have a chance. What do you guys think about that?
Well, last night they showed the search revenue grew a robust 5%. So
when I was covering Google, if they put a 5% print up, we take them out to the woodshed. Well, now you're telling me it's robust?
And YouTube Premium, that was the real standout. So YouTube ad revenue grew 4.5%. Premium, which is incorporated in their other segment, grew 24%.
Okay.
Compare that to a Netflix and Spotify. I mean, they're having all sorts of issues with churn, raising prices. In the case of YouTube, this is like YouTube Premium is almost an $8 to $10 billion revenue business, growing high teens. So they are taking share when it comes to streaming, and it's a higher margin business than Netflix because this is all user-generated content. So,
full disclosure, Bloomberg Markets is on YouTube.
There you go.
Just saying. All right, so Anurag, what does Microsoft say about ChatGPT, Bing? Is it a thing?
So for Microsoft, search revenue declining and going to be weak next quarter, and LinkedIn, which is based on advertising, declining and going to be weak next quarter. So we can tell that to Matt Miller.
Google really is a standard.
Exactly.
And Snap had some weak numbers too, right?
So social media ad pricing continues to be weak. We'll find out from Meta if that is the case, or Snap is, a standout in terms of the weakness. But I think search, we know, has the highest ROI when it comes to ad spend. And in the case of Google, clearly the ad pricing was much stronger than others.
So is there a potential read-through of the bad Snap numbers on advertising to Meta, or is Meta such a behemoth that you can't read between
I'm in the camp that Meta's ad pricing numbers will also be bad.
Okay.
Meta is doing well in terms of cost cutting, and they obviously are the scale player when it comes to social media. But this will still be a weak ad pricing environment for Meta as well. I think Reels may be a bright spot, given they have talked so much about, competing with TikTok and Threads. We'll find out more about it. I think they're going to pare back on their Reality Labs ambitions, the whole metaverse thing that was a big drag last year. But it's still, when you compare Meta's story, it's a combination of 4 of their most prominent apps. And the Blue app, which is about 40 billion run rate in our view, is still declining. And that is a tough void to fill when it comes to the top line.
Meta stock up 148% year to date.
Wow.
Up another 1.5% today. Go figure. All right, Anurag, when you talk, I know you and Mandeep and the tech team have put together this seminal report on AI. How do I find it on the Bloomberg terminal?
You can go to BI iNet Internet Dashboard, and
that's where it is.
Yes.
Okay, so that is the seminal report. If you want to know what AI is and whether it's a scam or a crock or whether it's real, like Dan Ives from Wedbush Securities says, you can go there and check it out. So BI space INET, you can find that report there. Anurag, when you talk to institutional investors, how are they playing? First of all, how do they view AI? Is it a seminal event in tech? And if so, how do they play it?
I mean, from our side, in the software side, it is the cloud providers that are going to really benefit from this, because you have to build those applications in the fastest processing environment, and that can only be on the cloud. Right now, Microsoft has an advantage because of its OpenAI relationship. We think Amazon will catch up over the next 6 to 12 months. We think Google's already there with their products. These three companies will benefit more than anybody else on the software side.
Well, I know that you know this, but I love the funny quotes from earnings calls, so I'm just going to repeat it for our audience. The AWS CEO said yesterday, kind of taking a shot at Microsoft, it's interesting that somebody who's not running their own models, like Microsoft, which outsourced to OpenAI, would argue that they've got such deep expertise in this area. What do you make of a comment like that?
See, but for the first time, Amazon's feeling the heat.
Yeah.
They haven't felt that in last 10, 12, 15 years.
They never have competition.
They have a massive competition now with Microsoft because they are coming up with products on a monthly basis. The pace at which they are coming up with add-ons to their core products such as Office, GitLab, I mean, it's just remarkable how that's happening. So, I mean, they have to be feeling pressure at this point. I think there's a little bit of that. I think Amazon Web Services is going to be weak next week when they report, and let's see what he says then.
All right, Mandeep, the ride-sharing biz. Well, what are we going to hear from the Ubers and the Lyfts of the world? And again, I am agnostic between the two. Whatever's got the lowest price, that's how I go.
I mean, so far the story is Uber is taking market share. Lyft has lowered prices to reclaim that share, but we know this is a scale business and there is a big focus on profitability this year. So clearly Uber is in a much better situation. The delivery side, I think, will continue to be a drag on their overall free cash flow. And the CFO transition, I think that was the other big news with Uber. So something that I think investors want to know more about.
Will those third-party partnerships be a tailwind for them heading into earnings?
For
like with
Uber?
Domino's, yeah.
Yeah, I think, look, if everyone realizes that they have the traffic when it comes to, people looking for a meal or a ride, Uber is the go-to place. It's a verb. And so every big chain right now is looking to partner with them just to be on the platform. Domino's is still doing their own delivery. So they're not
right.
And so that is what was interesting. They're just using them as a customer acquisition channel for people who are ordering online.
I just don't get it. Over the last 5 years, Uber's compounded annual return has been about flat. Okay, Lyft compounded annual return over the last 5 years negative 30%.
Wow. Huge
Is it
difference.
all because of Uber Eats? Which I don't do, by the way. I think the charges they put on for like a $20 pizza is ridiculous. But
it's a tough business. I mean, three-sided marketplace. It's a low gross margin business. You just can't change the margin profile of the business. And on top of it, it's so hard to maintain a supply. I mean, the supply is constantly turning. So.
Yeah. And in New York, you've got Curb as well, which is the cheapest by far. It's the taxi hailing app. So I know that's a very niche market, but
walk around the corner and get a slice. I mean, what's the big deal? Anurag Rana, Mandeep Singh, senior tech analysts. They lead our technology research coverage. How many analysts do you guys have around the world and all that stuff? Like 20?
Yeah, in the tech team, yes.
In the tech team.
Yes.
We've got 20 people doing nothing but the tech space, based in the U.S., based in London, based in Hong Kong and other parts of Asia. So we got the tech space covered. Check it out. Mandeep Singh, Anurag Rana, senior analyst, we're kind of running that business for us, and we appreciate that.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
All right, INGO. That gets you the Bloomberg Index browser. And I look at the Bloomberg U.S. Ag Total Return Value Unhedged. It's up 2% this year, so the bond people are doing a little bit better than last year, which was a disaster. And I look at the Bloomberg U.S. corporate high yield total return, that's up 6.5%. So again, some nice returns in the fixed income business this year after a dismal 2022. How do you play it? Well, one of the ways is through, you can do some ETFs, kids. Joanna Gallegos joins us. She's a co-founder of Bond Blocks. That is an ETF biz that focuses on the fixed income business. Joanna joins us here in our Bloomberg Interactive Broker Studio. So, Joanna, where are you seeing kind of opportunities in fixed income this year after, again, a very tough 2022 for that sector?
Yeah, I think in context of 2022 and the returns year to date you just mentioned, like those are returns of broad indexes in fixed income, ag and obviously high yield and investment grade. And what I really want investors to do and encourage them to do, and I think what Bond Blocks is all about, is look across the full spectrum of fixed income opportunities across asset classes, and in particular, look a little further down the credit spectrum, all the way up into high yield. And that's because there's a lot of difference across the credit space in sectors and in ratings categories. And right now, with yields the way they have progressed, and they're going to continue to progress for the rest of 2023, and the resilience we've seen in these corporations' balance sheets, you're being compensated very well for taking on this risk. You have a lot of income to cushion any potential downturns, and you should consider going even as far down the high, starting with triple B investment grade down to triple C and high yield. You really need to take a look at those spaces, because I think there's a lot of strength there, and so far through all of this 2023, I don't think investors are paying too much attention there as they should.
And how are you thinking about longer duration and the calculation in terms of how much positioning to do around longer duration?
Yeah, so I think the important thing for longer durations, if you're taking very long duration, you're thinking that something is going to turn with the economy, and that you're positioning yourself for that event. The way we see duration is that it's a really important, precise tool that you should be managing, and you should be careful of how it is existing in your portfolio, because it represents all the interest rate risk in your portfolio. So the way we think about it is across a whole spectrum of duration. So we would recommend that people along this path start adjusting their duration as we get more and more information. I mean, what people have been doing in our duration products to date is they've been buying the short side of the curve and reducing their duration as much as possible. I think they've really been doing that as a cash alternative, though, not really taking an investment view. And so here we are. Our view is that it's unlikely that there's going to be a recession in 2023, but we have the tools that allow you to express that view.
So where are you seeing your clients, or where are you seeing the funds flows across your products right now? Where are people? Because you could go to a piece of 2-year paper and get 4.9% just sitting in a 2-year treasury. Where are you seeing kind of some of the fund flows?
Yeah, so we're seeing a lot of flows in the shorter end, because people are still positioning themselves with those risk-free yields. Again, I'm encouraging our investors to look further out on either duration spectrum or the credit spectrum. But we've also started to see a couple trades across the treasury curve into the belly of the curve, 5, 7, and a few long trades. So there's some notion. There's still, overall in ETFs, treasury ETFs, government ETFs are still, close, except for July, we're 60% of flows in ETF fixed income flows. So people aren't really stepping into that risk yet.
What's in your high yield ETF products? What's typically in that ETF?
Yeah, so what's different, again, back to comparing us to a broad-based index, whether it's investment grade or high yield or even the ag, is that we've cut up the exposures in high yield in particular into ratings categories and also sector categories.
Okay.
And what is really fascinating is you can really play some of these views that you guys talk about every day. If you want the most balance sheet strength or with the lowest default risk right now, that would be the XBB product, right? So it's the first foray into high yield. That's the highest level of rating in high yield. If you really think that the recession isn't coming and we're going to avoid it in 2023,
which is what I think.
Yeah,
I'm just waving my
you
hand.
should consider looking at the triple C product. It's yielding a lot. The default rate isn't above normal averages, And, you know, if you even just, it's not about like going all in, but it's about maybe adding some of that exposure into your portfolio just to improve your results. Another, you've talked about it in the previous session, but like consumer cyclicals in high yield is the best performing sector in high yield. So it's telling you, obviously, that's the strength of consumer. But in our energy sector product is also a way to play a really strong balance sheet and high quality because of what's developing, you know, through the markets there. So the dispersion amongst the sectors and just the 7 sectors that we have is over 500 basis points. The best performing is close to 9%, which is consumer cyclicals. The worst performing is technology and telecom, and it's just about 3 or 4%.
Right.
So 500 basis point difference. There's a lot of opportunity that, you know, people should be considering as we still see this resilience, and, you know, we're getting closer and closer to the end of 2023.
Yeah, this consumer resilience ticker is so interesting. I have it up on my terminal right now. It looks like you are having a great year in that space. What are kind of the specifics that go into that? Because I'm fascinated in kind of the continued strength of the consumer.
Yeah.
So I'm curious about the calculation.
Yeah, it's the same type of categorization you see in equity sector products. It's a group of issuers in that sector, consumer cyclicals.
Yep.
And so what it represents is all of the debt in our high yield products are representing those firms' ability to cover their interest, their balance sheets, their revenues, and how well they're paying their debt. And so, you know, as the default rates are again maintained for like historical averages this year, spreads are actually tightening across the category in high yield, not widening. So there's a lot to like consider that, you know, whatever category it is, if you're an energy producer, if you're an energy company, that's what's in our energy sector. So you're benefiting from the characteristics of those sectors, plus the characteristics of those individual issuers and the resilience and the health of the fundamentals that are there.
All right. We always love talking to Joanna Gallegos, co-founder of Bond Blocks. They do the ETF thing, but they do the ETF thing with that fixed income focus. So we don't talk about that maybe as much as we should. So it's great checking in with Joanna occasionally.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's go right to our next guest, Alex Chaloff. Is it Chaloff or Chaloff?
Shaloff.
Shaloff. Okay, I'm on that.
Put your shawl on, you take your shawl off.
Hey,
there we go. Boom. I like that.
He's a smart guy because
Yes.
where did he get his MBA?
USC.
Best university in the world.
There we go.
Hello?
Fight on.
Please.
Fight on, man.
I like it. Alex Chaloff.
We've got a Duke guy in the room. So
CIO of Bernstein Private Wealth. That's a good name on this street, Bernstein. Alex, we got a Fed day today. We make a big deal of it here at Bloomberg. What are you looking for here? What are you telling your clients here as it relates to our Federal Reserve and its impact on the market?
No surprises this afternoon. They raised 25. Chair Powell is extremely hawkish in his comments. Market doesn't like it, but that's reality. And then we move on. It's all about September 20.
And as you know, Jay Powell has to be hawkish, and he's going to be, but sometimes you get a tiny slip up in his comments and he reveals a little dovishness. Are you anticipating that?
I think the last few meetings we haven't seen the slip up, or intentional or otherwise. Our view is that he is very deliberate in his language. It's like a free lunch. There's no cost to him being hawkish. It doesn't grow the balance sheet. It doesn't change the economy. He can do it. And if all the harm is that he moves risk assets down, that's okay. So I think he'll be very disciplined, very intentional in his language.
Well, Alex, I mean, the risk I see out there is he's going to push this economy into a recession. Who wants that? I've taken recession off the table personally, but he could push it right into a recession. Who wants that?
He could, but our house view is that a soft landing is highly likely.
Okay.
It's largely on the back, or almost entirely on the back today, of the strength in the labor market, which will flow through to the consumer. You have an unemployment rate, which for all intents and purposes is effectively zero. Anyone that wants a job can find a job. You've got 25 to 54-year-olds, 81% employed. That's a 30-year high. You've got wage growth finally tipping back to positive. So our view is that the strength in labor is strong enough to push us through. And look, if this is it, if this is a hike, some hawkish dialogue, and then a pause, or we get the same thing in September, we're through. So we are very close to the end of this. So we're optimistic about it.
What's your timeline on a soft landing?
It's going to be over. They'll tell you when it's over.
Okay.
Right? It's going to be one of these things where in a year they'll say, oh, guess what? We were 0.1 or maybe even had 1 quarter of negative GDP, but that's it. But it'll be a 2000 and end of 24 event where they talk about 23 and Q1 24.
Do you think there's a potential then of us getting to that soft landing, but the consumer still feeling like inflation is just as bad as it has been?
I think that's a reality. The good news is that household balance sheets continue to be strong, and you get some wage growth that continues to grow on itself. I think the compounding effect will make things easier. You've already seen some pullback in some of the blowout areas of inflation. Used cars has come down. Airline prices have come down. So they've been isolated, but they're starting to happen. So our view is that inflation isn't going away. It's not going to zero overnight. And it's not as if we'll be in a deflationary period. So you're not going to go fly Los Angeles to New York for $199 anymore. That's just the reality. But as far as year over year changes, those will be certainly less extreme.
All right. So given that kind of backdrop, what are you telling your Bernstein Private Wealth Management clients to do here? How much risk are you putting on the table for them?
There's 2 main themes that we're focused on. One is extend duration. Don't be afraid of the bond market.
Extend duration.
You got it.
Extend duration. Okay. All
It's cash. You've been nice.
But I'm getting 4.88% in my 2-year.
Cash and short term, we had a thing.
Okay.
It was okay.
Okay.
But now we got to move on. It's not you, it's me.
Right.
So we're breaking up with cash and money markets and looking at extending duration. I think you're going to clip the coupon while you wait for the Fed to be done. If we get an equity market sell-off, and everyone who thinks soft landing is wrong, guess what? Bonds are way more protective than something in money markets and short. And next year, our view, when they start cutting, you'll pick up price appreciation. So we might be early, but I'm okay. I'd rather be early than late here. And I think we're just on time, by the way. That's theme 1. Theme 2 is private markets. Take advantage of the dislocation that's occurred in the private markets and start to put money to work. That's probably a 3-year theme, but it's happening right now. Some really interesting opportunities in privates.
So how do you do that? How do you play the private markets?
I think you're patient, especially in real estate. I think you want to say, this is interesting, but this is probably a Q1 24 start date. So continue to watch, maybe for a selective deal here or there. It's interesting, but on a wholesale fashion, I'd wait till next year. Private debt, very interesting today. There's a lot of different ways that you can access that market with fresh capital, both for original originations, new originations, as well as secondary purchases. That's a big, juicy part of the market. And then I think in private equity, it's just start to dip your toe and engage in other people's mistakes over the next 2 and 3 years. So whether you do that through primaries, they're taking advantage of a reset in the valuation market, whether you do that through secondaries that are buying other people's mistakes and taking advantage of some real motivation to sell, I think there's a number of different ways you can play it.
Are you still seeing a lot of dry powder out there?
Huge, huge. I mean, the only thing that I would say is you're starting to see institutional LPs that took off 2023 because their portfolios were upside down with liquid versus illiquid. They've signaled to the market we're probably going to take 24 off as well. So big institutions walking away from the market. You still have sovereign wealth guys. They're not stopping at all, and in fact not turning that dial up. But then the ultra high net worth, the Bernstein client is looking at allocating to private markets in a greater degree than they have in the past. So I think you'll have that balance. It'll be a mixed shift of who's the owner. But yes, lots of dry powder.
How about the hedge fund allocation? What are you guys suggesting for your clients in terms of hedge funds?
It really depends on what you're trying to accomplish. I think hedge funds as a blanket category, people have had to revisit, and for good reason. Returns there were disappointing in 2015-16, 2018-19. Some of them weren't protective during COVID. But for someone that has a big equity exposure where they don't want to give that up, but they want something to neutralize it, that's where hedge funds play a role.
And I have to ask my favorite question here at Bloomberg, the AI play. Are you getting any questions about it? Are you hearing a lot more skepticism because of the wealth level of your clients?
I think our clients so the answer is yes. People are asking about AI. Bernstein has done tremendous research on the topic and have published on it in a number of different venues. But the questions our clients are asking more about the productivity, the change in the labor market. Will this destroy jobs in the next 10 years? Will my grandchild graduating college in 2025, are they going to have a job? That's where people are focused on. And our view is these things take a long time to play out. We'll likely have some productivity gains that will be additive to the overall economy, but there's some things that just can't be replaced. So I tell them what I tell my own kids, my teenagers: find something to do that a robot can't do.
Right.
And if you focus on that, you're going to be okay.
I think it'll be okay. What are some of the things you're suggesting your clients stay away from at this point?
I think, commodities are tricky. You've just got to be careful there. I don't know if that's a stay away from. I think that's an area. I think the shorter term, as I said, we're breaking up with short term fixed income. So I don't think there's some bomb that's going to go off in the treasury market in the 0 to 2s. But that you're going to give up. You're going to wake up in 3 years and regret having owned anything in short duration through this cycle. Other than that, this has been a wild market. It's like the rally that's like a non-rally.
Right.
And so it doesn't feel maybe to everyone that it is a rally, but we called the bottom in October. We wrote a note to our clients in October of last year to say the next bull market has begun,
Wow.
and it has.
Do you think the market's a little too far over its skis here? Again, the market's moved up 30 some odd % off of that low.
I think you're spot on, especially with what's going to happen with earnings. You had a negative earnings in fourth quarter, a negative earnings in first quarter. Our expectation, I think we're right on the market of a negative 8% earnings. So this is the real, nuclear winter in the earnings cycle for the S&P. And if you look at where the S&P levels are, we were before this morning 5% away from an all-time high. That there's a disconnect there. So
Yeah.
we're people talk about the Magnificent Seven.
Yep.
We talk about the forgotten 493. And that's
Right.
where the interesting opportunity could be in the next chapter.
Where are you seeing the most opportunity within the smaller caps that's being ignored right now?
Small caps are really interesting. I mean, the growth part of that market has exploded, having a terrific year. The more value, which is really banks, small cap value on a look-through basis are basically financials. And we know what's happened there over the spring and the stress around bank failures. So I think small cap as an overall allocation still makes sense. It should be a smaller part of the portfolio. But I'd rather play that as an asset class than try to find a name or two.
Yeah.
You can be active, and we are in the small cap space, but I don't think you want to be concentrated in any way, shape, or form.
Just 30 seconds left. Energy, kind of people, I don't think can really agree on what to do with the energy trade. Are you guys still long energy? Because it had a good run over the last several years.
We've been selective in energy
Okay.
and frankly had the right name, so feel really good about our exposure. But, long term, a lot of questions around the energy platform and the infrastructure, the cost of debt. It's heavily levered as a space. So just be cautious.
All right. Alex Shaloff, thanks so much for joining us. Alex Shaloff, he's the CIO of Bernstein Private Wealth.
You're listening to The Tape, Cantor Live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Bank news continues to hit the tape. We had some earnings out. We had some buyback information out. Let's bring in Allison Williams. She's a senior analyst for Bloomberg Intelligence, covering all the global banks. And Allison, let's start with Deutsche Bank. They had some earnings today. What's the takeaway for the German lender?
I think the takeaway was that core trends are pretty good, similar to what we saw at the U.S. banks, that net interest income is holding up better than expected. So obviously we're different rate regimes, but that is the key positive, and especially true for Deutsche Bank. Trading, which is the biggest part of their business, fell 10%, so that doesn't sound heroic, but it's better than the 15 to 20% view that they've had in June, and they have an outlook that should be improving in the second half. But their corporate bank and private bank, which are their more stable recurring revenue businesses, also doing better, increasing their share of the overall top line, so investors like that. Core cost cutting coming in line. They're delivering on their efficiencies. Investors like that. What investors don't like, I would presume, was a negative for me at least, is the fact that their non-recurring costs coming in higher, so restructuring, legal costs that we've heard a lot about, and severance. So this is something that we've seen at most of the U.S. banks. Citi and Morgan Stanley had relatively bigger charges, but we know that there's job cuts. The severance costs come today, but should help the second half profit. And then finally buybacks, which they had actually announced last night. So it's a $450 million buyback. It's about 2% of their market cap. That's no way in comparison to, you look at Wells Fargo, who also had an announcement last night, $30 billion program, 18% of the market cap, although that will be over some period of time.
I want to transition stateside and talk about PacWest, which was up by 30% earlier today, now up by 27% on that news that it'll be sold off to Bank of California. Talk us through that deal and why the market is responding so positively to both of those names.
I mean, I think, to some extent, just getting some resolution to some of the issues that we saw in March, and PacWest was, certainly one of the banks that investors have been watching. And I would say that, the fact that that deal will get done, and the fact that across the industry broadly, we're seeing deposits stabilize, the cost of deposit pricing going up in the quarter, but generally the outlook more favorable is giving a lift to all the banks.
Allison, you talked to us. You mentioned the Wells Fargo buyback, $30 billion, 18% of the outstanding. That is size, of course. What does that say about the regulators' view of the big U.S. banks? Now that they're allowing them to return some capital to shareholders.
So I think Wells Fargo is a little bit of an exception. Certainly the regulators are allowing them, today, but tomorrow we do get these Basel III endgame rules, and so that's going to be sort of another kink in terms of raising capital requirements for these banks. For Wells Fargo in particular, because they do have such sizable excess. And again, it's a $30 billion, but it's not necessarily today, so it's over a specific time frame. But the Basel III endgame rooms are thought to be a little bit more punitive on the trading side of things. That's a smaller business for Wells Fargo.
And moving back to the regionals, again, are you anticipating that the regional bank rally that we're seeing today because of the PacWest move, is that something that's going to be a little bit short-lived, or are we seeing more success to come for some of those regional names?
Well, I think, going back to my comments on, the deposit stabilization and just sort of moving past this issue in March, right? So that was really where the dramatic underperformance came from these banks. First was the fear, and then was just the recognition that, beyond the fear of deposit flight at a few specific banks, there was this broad fear about the cost of deposits rising, those deposit outflows. That migration is expected to continue, but certainly not at the fearful pace that we saw in March. We saw that things were much more stable in the second quarter. And then, the outlook from the banks is that will continue to look better. Of course, part of that is predicated on rate cuts from the Fed that are built into the curve in the coming quarters. So monetary policy will continue to play a role.
Allison, talk to us about this Basel III rules that you referenced. Pretend like we know nothing about what they are. So tell us what they are and why they're important for the big banks.
So first is just the name Endgame. I mean, can we finally just get the final set of rules that we'll be dealing with? The Basel III implementation has been, the guidelines and the rules. This has been going on since the financial crisis. So well over a decade in terms of regulators aim to make the banks safer. And so this last set of rules, which is really the U.S. Regulators' view on implementation, it'll be good to get the final set of rules. I would say that our regulatory and policy experts in BI, we are expecting that there will be increased requirements across the biggest banks. Regulators have sort of broadcast that could add like a 2 percentage point increase to their capital ratios. This will be the proposal that we get tomorrow. It might not become finalized until perhaps a year from now, and then there'll be a couple of years phase-in period. So the banks, certainly have enough, money that they're generating in terms of internal capital to meet these guidelines over any such time period. But obviously, it's a negative because it'll lower returns. That's how investors look at the profitability of these banks. But the other side of that is that they are safer and more sound, and so perhaps that could help the multiples.
All right, Allison, thanks as always for joining us and giving us your analysis and expertise on the global banking space. Allison Williams, Senior Global Banks Analyst for Bloomberg Intelligence, joining us on the phone there. Again, Wells Fargo, big stock buyback, $30 billion. That's good news for Wells Fargo shareholders. Deutsche Bank putting up some numbers, as Allison said, were generally pretty solid in a tough environment for a bank that's had its challenges over the years.
Thanks for listening to the Bloomberg Markets Podcast. You can subscribe and listen to interviews at Apple Podcasts or whatever podcast platform you prefer. I'm Matt Miller. I'm on Twitter at MattMiller1973.
And I'm Paul Sweeney. I'm on Twitter at PT Sweeney. Before the podcast, you can always catch us worldwide at Bloomberg Radio.